Yield curve inversion. Normally, lending money for longer periods means you earn higher interest. Lenders demand more compensation for tying up capital and facing greater uncertainty. Plotting these interest rates against immaturity creates an upward sloping line, the yield curve. Short-term bonds pay less, long-term bonds pay more. This healthy, upward slope reflects a market anticipating growth. But occasionally, this relationship flips. Short-term bond yields, like those on 2-year treasuries, climb above long-term yields, such as those on 10-year treasuries. This unusual situation is what economists call a yield curve inversion. It is a rare occurrence, and when it happens, it sends a ripple of concern through financial markets. Why would investors accept less for lending money longer? This phenomenon is often driven by expectations of an economic slowdown or recession. When investors anticipate a downturn, they flock to long-term bonds, seeking a safe haven. This increased demand pushes up bond prices, which inversely drives down their yields. Simultaneously, central banks, battling inflation, may aggressively hike short-term rates. This combined pressure creates the inversion. Historically, a sustained yield curve inversion has been a remarkably accurate predictor of recessions. It has preceded nearly every US recession since the 1950s, often by several months or even a year. It isn't the cause of a recession, but rather a strong signal that market participants collectively foresee trouble ahead, a sentiment reflected in their investment decisions. It acts as a potent barometer for future economic health, suggesting a consensus that current conditions are unsustainable. The critical question then becomes, how long does the signal persist before its prediction truly plays out? Interest rate hikes. When prices rise too quickly, eroding the purchasing power of every dollar, central banks often step in. Their primary and most powerful tool? Raising interest rates. This isn't a minor adjustment, it's a deliberate, calculated move designed to cool an overheating economy. By pushing up the cost of borrowing money, central banks directly impact demand. Suddenly, taking out a mortgage for a new home becomes more expensive. Businesses find that loans for expansion, new equipment, or hiring cost more, potentially leading them to delay or scrap projects. Consumers reconsider buying that new car or making other large purchases that rely on credit. This collective reduction in borrowing and spending drains excess money from the system. This money chasing the same goods and services should, in theory, slow the pace of price increases, bringing inflation back down to manageable levels. But this economic medicine carries significant side effects. Businesses may reduce investment, leading to slow job creation or even layoffs as they brace for tighter times. Stock markets often react negatively, as higher borrowing costs eat into corporate profits and make future earnings look less attractive. Home sales can slump, and consumer confidence might dip. Central bankers must walk a precarious tightrope. Raise rates too aggressively, and they risk pushing the economy into a deep recession, causing widespread unemployment. Maintain rates too low for too long, and inflation could become deeply entrenched, continually eroding savings and living standards. It is a strategic gamble, a constant calibration of economic forces, aiming for stability without crushing growth. The full implications of these decisions, both immediate and long-term, touch every household and business, fundamentally reshaping the economic landscape. Rising inflation. Imagine your weekly grocery bill suddenly costs significantly more, but your paycheck hasn't changed. That is the most direct experience of rising inflation. Inflation itself is the rate at which the general level of prices for goods and services is rising, and, consequently, the purchasing power of currency is falling. When we talk about rising inflation, we mean this increase is accelerating, impacting everyday life more profoundly. Several factors can push prices upwards. Sometimes, strong consumer demand outpaces the available supply of goods. Think of a popular new product everyone wants, driving its price higher. Other times, the cost to produce goods increases significantly. This could be due to higher raw material prices, like oil, or increased wages for workers. Global events, such as widespread supply chain disruptions or geopolitical conflicts, can also force prices up as it becomes more expensive and slower to move products around the world. Even government spending can contribute by injecting more money into the economy. For individuals, rising inflation erodes the value of their savings. $1,000 today buys less than it did last year. Businesses face higher operational costs, which they often pass on to consumers. Wage increases might lag behind price hikes, meaning real income effectively shrinks. This creates a difficult balancing act for households trying to manage their budgets and maintain their standard of living. The challenge for central banks and governments is to cool this upward price spiral without stifling economic growth, a delicate task that impacts every pocketbook. Commodity price surges. Across global markets, a stark pattern emerged. The price of essential commodities began to climb, sometimes sharply. Oil, a core input for nearly every industry, surged. Wheat, a staple for billions, became significantly more expensive. Metals like copper, vital for construction and electronics, saw their values escalate. This wasn't a singular event, but a confluence of pressures pushing foundational goods upwards. Supply chain disruptions, initially sparked by global health crises, left factories short of components and ports congested. Geopolitical conflicts then tightened energy markets, making transportation and production costlier. Extreme weather events, increasingly frequent, battered agricultural output, reducing harvests and driving up food prices. These shocks to supply happened just as demand began to rebound globally. As economies reopened, the appetite for raw materials intensified, often outpacing production capacity. This combination of diminished supply and surging demand creates a powerful inflationary force. Businesses face higher input costs, which they invariably pass on to consumers. For households, this translates into elevated prices at the gas pump, the grocery store, and everywhere else. These commodity price surges aren't just economic statistics, they ripple through daily life, reshaping consumer spending habits and posing tough questions for policymakers about resilience and global interdependence. Excessive valuations. Beneath the surface of seemingly robust markets often lurks a silent threat. Excessive valuations. This isn't just about high prices, it's about prices detached from fundamental reality. Imagine a company whose stock soars, not because its profits exploded or its market share expanded, but because of a narrative, a future promise, or pure speculative fervor. Its price climbs far beyond what its current earnings or assets would reasonably justify. This disconnect can sweep across entire sectors, even the broader economy. We've seen it with internet companies in the late 90s, where firms with no profits and minimal revenue commanded billions. We've seen it in real estate, where home prices in certain regions decoupled from local incomes and rental yields. The market becomes less about sober analysis and more about a belief that someone else will pay even more. Investors chase momentum, fearing they'll miss out on quick gains, driving prices higher still. Low interest rates often fuel this environment. When borrowing money is cheap, it incentivizes risk-taking and makes future earnings appear more valuable today, stretching valuation models to their limits. Easy capital flows into assets, inflating their perceived worth. This creates a precarious balance. When valuations stretch too far, the market becomes exquisitely sensitive to any change in sentiment, economic data, or interest rate policy. The question then isn't if a correction will occur, but what precisely will trigger it, and how widespread its impact might be. Debt accumulation. For many, the journey into debt begins subtly. Perhaps it's a new credit card, initially used for small, convenient purchases. Maybe it's an unexpected car repair, or a medical emergency, forcing a decision between immediate payment and taking out a loan. Student loans represent another significant entry point, especially for young adults starting their professional lives. What often starts as a manageable sum, a necessary investment, can quietly transform. The insidious nature of debt often lies in compounding interest. That initial credit card balance, if not paid in full, carries a percentage charge that adds to the principal each month. Minimum payments, while offering a temporary reprieve, often barely cover the interest, leaving the original debt largely untouched. This cycle can quickly escalate. A small balance balloons, prompting people to take on more credit, perhaps another loan, just to keep pace with living expenses or existing payments. This pattern isn't just about financial numbers, it's also deeply psychological. The ease of swiping a card or signing a loan agreement can overshadow the long-term commitment. Each new debt, taken on to cover an existing one or a new need, piles atop the last, creating a heavier burden. Before long, individuals find themselves in a precarious position, spending a significant portion of their income simply servicing debt, rather than building wealth or even comfortably meeting daily needs. The escape route narrows, often unseen, until the walls feel like they're closing in. Slowing earnings growth. Companies live by their earnings, the ultimate measure of their financial health and success. When we talk about slowing earnings growth, it doesn't always mean a company is losing money. Instead, it indicates that the rate at which their profits are increasing has begun to decelerate. This deceleration can stem from a variety of factors, often intertwined, signaling shifts in the broader economic landscape or within specific industries. Perhaps consumers are pulling back on spending, reducing demand for goods and services. Or, businesses face mounting pressure from rising operational costs, higher wages, more expensive raw materials, or increased energy prices eating into profit margin. New competitors might emerge, intensifying market rivalry and forcing companies to lower prices or spend more on marketing, further dampening their growth trajectory. Even global supply chain disruptions can play a role, making it harder and more expensive to produce and deliver product. For investors, slowing earnings growth triggers concern. Share prices often reflect future profit expectations, so a reduced growth outlook can quickly lead to a sell-off. Internally, companies might respond by tightening budgets, pausing hiring, or even reconsidering expansion plans. This slowdown isn't merely a corporate headache, it acts as a critical barometer, often preceding broader economic contractions or indicating a period of significant adjustment for the market at large. What does this mean for the future of investment, and how do companies adapt? Declining market breadth. Imagine the stock market as a vast ecosystem. For a market to truly thrive, its growth should be widespread, with many different companies and sectors contributing to the upward momentum. But sometimes, despite headline indices hitting new highs, a different story unfolds beneath the surface. This is what we observe with declining market breadth. It means that while the overall market, as measured by major averages like the S&P 500, might appear strong, fewer and fewer individual stocks are actually participating in that advance. Instead, the gains are concentrated in a small number of dominant companies, often mega-cap technology or growth stocks. A healthy market typically sees broad participation across various sectors and company sizes. When only a handful of powerful equities drive the entire index higher, it suggests a lack of underlying, widespread strength. This narrow leadership can create a distorted picture, where the market's upward trajectory is highly dependent on the continued performance of these few leaders. This concentration makes the market more vulnerable. If those leading stocks falter, there's little underlying support from the rest of the market to cushion the blow. Historically, periods of declining market breadth have often preceded significant market corrections or slowdowns. It raises a critical question: how sustainable is a rally built on such a narrow foundation? Increased margin debt. In the intricate machinery of the financial markets, a quiet, yet powerful force operates: margin debt. This isn't just about borrowing money, it's about investors using borrowed funds from their brokers to purchase even more securities. Think of it as leverage for your investments. When an investor buys stocks on margin, they are essentially taking out a loan, with their existing portfolio often serving as collateral. The appeal is clear: during a bull market, amplify potential returns. If your invested capital grows by 10%, your margin-backed investment could net you a much larger gain, assuming the market keeps climbing. This optimistic outlook, coupled with readily available credit and historically low interest rates, often fuels a significant surge in margin debt. Investors, buoyed by rising asset prices and a belief in continued upward momentum, become more willing to take on this additional risk, pushing the total borrowed amount to record highs. But this escalating reliance on borrowed money introduces a precarious element into the market stability. While it supercharges gains during good times, it also magnifies losses when the market turns. A sudden downturn can trigger margin calls, demands from brokers for investors to deposit more cash or sell assets to cover their loans. This forced selling, often into a falling market, can create a powerful negative feedback loop, accelerating declines and turning individual investor distress into broader market volatility. The higher the margin debt, the more susceptible the entire system becomes to a rapid, sharp correction. Consumer confidence drop. When people feel secure about their jobs and their financial future, they spend. This simple act fuels economies. But what happens when that feeling shifts? Consumer confidence, essentially the collective optimism or pessimism households hold about their economic prospects, provides a crucial indicator. It is measured through regular surveys, polling thousands on their present financial situation and their outlook on jobs, income, and overall business conditions 6 months down the line. A drop in this confidence isn't just a statistical blip, it reflects real-world anxieties. Inflation, for instance, erodes purchasing power, making every dollar buy less. People notice rising prices at the grocery store or gas pump and begin to worry about their budget. Job market uncertainties, even whispers of layoffs, make individuals hesitant to commit to major purchases. Rising interest rates mean borrowing for a new car or home becomes more expensive, pushing those decisions further away. These concerns translate directly into spending habits. When confidence falters, households pull back. They delay buying that new appliance, postpone home renovations, or cut back on discretionary spending like dining out or vacations. This reduction in demand hits businesses hard. Retailers see fewer sales. Manufacturers scale back production, and service providers notice a dip. The collective decision to tighten belts, driven by fear or uncertainty, reverberates throughout every sector, shaping the immediate future of the market and the lives within it. Volatility spike. A sudden, violent lurch across financial markets often signals one critical event: a volatility spike. It is not just about prices moving, it is about the asterisk speed asterisk and asterisk magnitude asterisk of this movement accelerating dramatically. Think of it as the market's heartbeat suddenly racing out of control, reflecting a profound and rapid increase in perceived risk. These spikes rarely emerge from thin air. They typically follow unexpected news: a sudden shift in geopolitical tensions, a shocking economic data release, a technological glitch, or the collapse of a major institution. What starts as a tremor quickly becomes a quake. Algorithms, designed to react instantly to market data, can amplify these initial signals, triggering cascades of selling or buying. Prices swing wildly, orders fail to execute at expected levels, and the bid-ask spreads, the difference between what someone will pay and what someone will sell for, widen rapidly, reflecting a severe lack of liquidity. Human traders, witnessing their screens flash red or green with unprecedented speed, often succumb to panic, selling indiscriminately to cut losses. Others, the more seasoned or daring, might try to seize fleeting opportunities, but even veteran professionals find themselves navigating uncharted waters where familiar patterns dissolve. Market fear metrics like the VIX index surge, indicating that options traders are suddenly paying a premium for protection against future swings. This sudden leap in uncertainty forces every participant to reconsider their position, their strategy, and their trust in the underlying order of financial instruments. How do such events reset market expectations? Technical breakdown. For decades, communication relied on a simple but inefficient principle: dedicated lines. When you made a phone call, a physical circuit formed, connecting your phone directly to the recipient desk. That line remained open and reserved for your conversation, whether you were speaking or not. This circuit switching worked well enough for voice calls, but it severely limited the potential for complex data transfer. Imagine trying to send an email, then waiting for an entire dedicated circuit to form, only to dismantle it seconds later. The internet shattered this paradigm through a revolutionary concept: packet switching. Instead of reserving a continuous line, data, whether it's a web page, a video, or an email, is first chopped into small, manageable chunks called packets. Each packet isn't just data, it carries a header, a digital address label containing its origin, its destination, and instructions on how to reassemble the full message. These packets don't follow a single, predetermined path. They travel independently across the network, navigating through routers and switches, finding the most efficient available routes in real time. One packet might go through New York, another through Chicago, both heading to the same final destination. Once they arrive, often out of order, the destination device uses the embedded instructions to meticulously reconstruct the original data. This dynamic, decentralized approach allows billions of devices to share the same infrastructure simultaneously, transforming a bottleneck into an adaptable, resilient network capable of handling immense traffic loads. This technical foundation is precisely why the internet doesn't collapse under the weight of constant global communication, making services like video streaming and cloud computing not just possible, but commonplace.